Investing can get really complicated really quickly, and honestly, I get it. But I don't think it needs to be so complicated. So in this video, I'm sharing 5 ETFs that I'm using for my pension portfolio to grow my wealth in the long run and keep things nice and simple. Because let's be honest, we've all got busy lives and way more things to be doing than trying to outsmart the market every single day. And frankly, it's not necessary. In an ideal world, I want to construct a portfolio that is globally diversified, minimal maintenance, and grows my wealth in the long run so that I can achieve the freedom that I want. So instead of trying to pick the next winning stock, these 5 ETFs that I'm picking for my portfolio are a blend of US markets, internationally developed markets, emerging markets, bonds, and some commodities in the form of gold as well. Nothing super complex, just broad exposure to the global economy and markets. My name is Zoe and this is my channel, Words on Wealth. I'm a former wealth manager and I make these videos to break down some complex investing terms into simple takeaways. Now, it's worth just saying before this video as well that this is not financial advice and you should always make sure that you do your own research before carrying out any investments. These can all act as some sort of guideline, but it's super important that just because it's right for me doesn't mean that it's exactly right for you. So with all that said and out the way, let's get into the first ETF of the day. Now, I'm here in the UK, so I'm going to be sharing the ETFs that I can find here in the UK, but I'll also make sure I include equivalent tickers for both the US, Canada, and Australia as well. Now, the first ETF that I'm introducing is the S&P 500. It is the solid, the core, the one that most people talk about when it comes to investing, and it tracks the 500 biggest companies in the US. There are loads of different ones out there. I tend to lean towards the iShares UCITS one, or indeed the Vanguard UCITS one. The reason being is that they're some of the biggest, most popular and cheapest, and also readily available on the market. Now, within these 500 biggest companies, I've got exposure to the big names, the likes of Nvidia, Apple, Microsoft, Google. You get the idea. It is one of the, if not the, biggest players in most people's portfolios. There's a few reasons for that. Firstly, it's got the historical data to back it up that it consistently grows. Secondly, the US is still the biggest stock market in the world. And third and finally, it's still proving itself with relatively strong growth. So whilst, yes, introducing this ETF as 20% of my overall pension portfolio, some might say, particularly at the moment, is relatively US heavy, I believe that it does have the backing to carry us through. Now, onto my next ETF. I'm going to be picking the Vanguard FTSE All World Developed excluding US. What a mouthful. Now, for me, what this ETF really does, or indeed this combination of ETFs, if you do break it down a little bit further, is it introduces further global diversification in other developed nations outside of the US. Because honestly, whilst the US does have that data and global historical points of growth, I don't want to have all my eggs in that one basket. So I'm going to broaden it into the likes of the UK, Europe, and other nations as well. Now, the third ETF I'm introducing is the iShares MSCI Core Emerging Markets ETF. Now, for me, my retirement age is a bit of time away, at least 20 years. And so from an investing perspective, we consider this to be a relatively long-term time horizon. I also, of course, have financial knowledge and therefore a risk profile that is appropriate to put emerging markets into my portfolio. For some, they'll be slightly too high risk. If, for example, you're closer to retirement, or if you're somebody that is not comfortable with taking that level of risk. And that's fine. If that's the case, you might get rid of this ETF and just up your exposure to the developed market sections. But for me, this emerging markets ETF is really the growth card. It's hopefully the part that is going to drive some growth within the overall portfolio and push some boundaries. Sure, there might be some years where the volatility is quite high, aka it actually goes down potentially quite a lot. Because emerging markets contains countries like China, India, South Africa, Brazil, Nigeria. There's all sorts of different nations in there that are facing a whole manner of different growth potential and also potential issues. So that's my final stock-based ETF that I'm going to be adding into my pension and into the overall globally diversified mix of stocks. There are now thousands in there. The fourth ETF I'm going to be introducing is the iShares Core Global Aggregate Bond. Another little mouthful of a title there for you, but what this fund basically is a whole basket of bonds from across the globe. Now, quick recap for anybody that's unaware, a bond is slightly different to a stock. The previous 3 ETFs have been based in stocks where you own a tiny little bit of the company. This is now focusing on bonds. Bonds have traditionally been seen as a stabiliser to stocks, i.e. they move in different directions. They're more like a debt, they're an IOU to either a company or a government. Now, when you own bonds as well as stocks in a portfolio, which is pretty normal for particularly a long-term retirement plan, what this can help to do is to balance out volatility and make sure that you've kind of, again, spread your eggs into different baskets and got different assets in there now as well. Now, from that super simple explanation there, I've actually kind of glossed over what is a huge market, bigger than the stock market in size, but also quite a complex instrument. Now, bonds are, as I say, quite complex, but the nice thing about this ETF is it keeps things simple. It gives you exposure to bonds all over the world of different durations, because they have different durations, which affects what they pay and how risky they are, and it just removes you one step away and keeps things nice and simple. Now, one thing to note is that bonds aren't going to set your world on fire, and it's quite likely that you'll be looking at their performance in time thinking, I don't really get why she said put these in here, this is just going to drag the portfolio down, this is really boring. The reality is that usually when stock markets are doing badly, bonds tend to do well. And so you have to just be patient for when the rest of you is panicking and you're thinking, I've got it. That's why she said about those bonds. Because actually having a globally diversified spread, but also an asset diversified spread within your portfolio helps to reduce that maintenance and helps to keep things ticking over rather than having to be actively managing what is doing well and what is doing badly. And last but not least, I'm going to be throwing into the mix the iShares Physical Gold ETC. Now, firstly, it's called an ETC rather than an ETF because it is an exchange traded commodity, aka it is tracking a commodity. In this case, it is gold. Now, gold has really hit the headlines in recent years. It has been booming in its price. And it's also sat alongside bonds as a kind of stabiliser once again to stocks. Often gold behaves inversely again to the stock market. And what this can mean is, much like bonds, it helps to balance out your overall portfolio. Now, bonds and gold have been behaving a little bit differently in the last few years. What that means is that everything's just been going up. But we can't predict the future, and we don't know that that is going to continue. So what I believe is that having both gold, bond and stock exposure within my overall pension portfolio will really help to just stabilise out whatever this future is going to bring to us and make sure that I have diversification across different asset classes as well. So to take these ETFs and make them work for you, what you need to do is the following. First and foremost, find the ETF that works for you in your country. It will be slightly different, and there might be slightly different availabilities even within the UK, for example. But the good news about ETFs is that they're all relatively similar and they're all holding the almost same things in that basket. The second thing you need to do is to pick the share class, because extra confusion, when you look at ETFs, there will always be 2 of every type. One will give you the dividends or the income that they receive, and one will automatically reinvest it for you. Now, the way in which you choose is a few different factors. Firstly, have a look at any tax implications. If you're investing in a pension in the UK, there aren't any, so you don't need to worry, but in other countries, there might be. And secondly, have a little look at as well if there are any price differences within those. Now, I tend to go for the automatically reinvesting, and that is the ACC, accumulating share class. The reason being is it just helps to keep my maintenance even lower. If you're closer to your goal and you eventually want to take the income from your investment, then you might go for the income or distributing one, because then the income's already there. And then the third thing you need to do is to pick your splits. And this will all come down to your risk profile and what you want in your portfolio. Some people might start super simple and just put 20% into each and every one. This would be the easiest way to get started, but it might not be super appropriate for your risk profile. Let's think about those emerging markets again. If you put 20% into emerging market stocks, you've got quite high exposure to potentially quite high risk investments there. If you're closer to your retirement goal or have a lower risk tolerance, then you might want to increase, for example, your exposure to bonds and decrease your exposure to the likes of emerging markets and indeed other major market stocks as well. Some might equally choose to reduce their exposure to gold, given that it's still been relatively volatile, and increase their exposure to the known quantities of, for example, the S&P 500 stock market. You can play around with these different levels, and I really would suggest that you use an online tool and I'll put some links in the notes as well. I'll put a link in the video notes to a really useful tool that I like and have found that actually helps you to visualize how much different levels and different exposures to different portfolios can move through the years, or how much they have moved in previous years, and therefore how much you could really withstand. The point of this portfolio is that it is simple. It allows you to grow your wealth, to hopefully hit your retirement or indeed any other financial freedom targets in a way that is simple and you can still live your life. You don't need to become somebody that has 5 screens on the go showing all major markets at all times, and you don't need to be somebody that is watching and clicking and changing all the time. Your pension is designed for long-term wealth, and it's designed in this way for simplicity, so make it as such. And as a final note from me, do make sure that you're liking, subscribing and turning on your notifications if you're enjoying these videos. Hopefully they're super useful, and of course I do read everything, so if there's any other videos that would be super helpful for you in the future, just let me know.